Londra'dan herkese merhaba. Bu bölümde piyasalara özel bir parantez açıyoruz. Yanımda çok değerli bir konuk var. Mohit Kumar'la birlikteyiz. Kendisi Jefferies'in Avrupa Başekonomisti ve Yönetici Direktörü. Hi Mohit, thanks for joining our program.
It's my pleasure.
First of all, when we are talking about financial markets, we can make a huge list. You know, there are lots of risks. We are talking about AI bubble, Fed uncertainty, debt issue, and geopolitical risks as well. When you look at all these risks, and if you want to add more, please do so. Which one is the most important thing that can trigger a financial rupture?
I think when you think of a financial rupture, I would say it's probably AI. And in AI, there are two parts. One is the return on capex, which is whether AI is a bubble or not. And that's a big question mark. We think it's probably 2 years away. It's not a 2026 story. But what could be a 2026 story is the AI disruption. So how AI is going to change the macro landscape in terms of software, we have already seen some examples, but it is going to spread to other industries as well. It could be financials, it could be legal, and that has big implications for the job market, for inflation. So to me, that is probably top of my list of concerns right now.
So you expect an AI bubble burst in 2028? Which is 20 years after 2008 financial crisis?
I actually do not expect an AI bubble burst. So why are people talking about AI bubble? It's all about capex. We have seen huge amount of investments in AI infrastructure, in AI technology. And the question is, will we get enough returns? Now, why I said 2 years away, or at least 2 years away, is the benchmark I have is leverage in the system. So if you look at .com, compare it to today, the capex that has gone has been from companies that have been cash rich. It is not leverage. All we have seen is leverage start to increase in the last 3 to 4 months. And if you look at our projections of how much these AI companies are going to issue, it would be at least till end of 27, where leverage is kind of comparable to .com era. Now, that doesn't mean it will burst, but what it does mean is it's unlikely to be a big issue this year.
Mm-hmm. So you say that AI bubble is an issue, but it's not the story of this year. But so what is the story of this year? For example, Iranian risk, geopolitical risks?
Actually, I would say it's the disruption of AI, which is an issue. Because AI is fundamentally going to change the workforce. It's going to have changes in a lot of industries.
Companies.
The companies. So software, for example, AI can reproduce a software code which could take a number of people to do, which means it's starting to impact the revenue model of these companies. And what is happening is you have to look at two sides of the story. There's a revenue model, there is a cost model. Now, companies where the revenue model gets impacted should be negatively impacted by AI. And this is what has happened in the last month. I think it's going to expand to a number of other industries as well, not just software. And then at some stage, we should start thinking about the cost model, in the sense that a number of companies will benefit from lower cost. But that also means lower employment because they will likely be laying off people. So that, I think, is probably the biggest issue that I should worry in 2026.
So do you think the markets are pricing this risk right now?
Not obvious. Not obvious because what we have seen right now is a very specific industry sectors getting impacted. So, of course, software, we saw a bit of impact on financials, but other industries, no. So I think that is what is not in the price. But what it also tells me is, if I look at both the good things and the bad things, there are winners and losers. Because like I said, if a company gets impacted on revenue side, it's a loser. If it gets impacted on the cost side, it's a winner. Also, there are winners and losers across geographies. So economies which have a young dynamic population should be winners. Economies which have an aging population should be losers. And that's why in our perspective, and that has been one of the core themes we've been following, is emerging markets are the big beneficiaries. A younger population, more dynamic population, also valuation is much better than US. So we've been shifting away from US tech into EM, and that remains one of our core calls for this year.
So this AI issue is the biggest concern as an economist that you're watching very closely right now, as I understand. What about the geopolitical risks? Is there an imminent risk, for example, in terms of Iran? Do you expect a military action from US, or do you think diplomacy will prevail?
So I'm not a geopolitical expert, so I couldn't really say. But when we think from the market perspective, if you look at past episodes of geopolitical risk, The market has, yes, reacted in a week, 2 weeks' time, but largely ignored it over a medium term. And our base case remains that we are not looking for a drawn-out conflict. We are not looking for a big escalation. Can there be some wobbles? Absolutely, maybe. But like I said, I'm not a geopolitical expert. But we're not in the camp of a long drawn-out war. Which means from the market perspective, you will get a week, 2 weeks of uncertainty, very much possible. But if you have a 3 month, 6 months horizon, we are not really worried about geopolitics right now.
Okay, if there's a military action, it will be short-lived, you think, as far as I understand from what you say. And what about the oil markets impact? Shall we expect another wave of inflation because of the oil markets? Because it's over 70 right now, Brent especially.
So our base case is, if you look at our year-end forecast, it's close to $60. So can oil go to 80 if, let's say, we get some geopolitical risk? Yes, very much possible. But our base case is it will be short-lived. Now, why do we have $60 as our price target? In our mind, it's a lot about the market share between US and Saudi. And if you look at shale gas, which is a big supply of oil, the variable cost of shale gas production is around $50, which means that 60 or just below 60, a lot of projects are not really viable. So if you have this trade war between Saudi and US about oil market share, just 60, below 60 is, I would argue, what Saudis would want oil price to be. Also, let's think from Trump perspective. We have midterm elections, and we do not want inflation going into midterm elections. So Trump would also want oil price lower. So if you have the two big blocks, which is US and Saudi, looking for oil around 60 as a sweet spot, that is our forecast for where oil should be.
So any surge will be short-term in terms of oil.
That is our view.
So what about dollar, euro? Do you think dollar is losing its tone? Everybody's talking about that. Do you think euro can preserve its value? What do you say?
We are absolutely in the camp of weaker dollar. But I always say that FX is a relative value trade. When we think about weaker dollar, where else should I park my money? I would argue that euro is not the obvious place. So can we go euro dollar to 120, 122? Absolutely. That's our base case. That's our forecast. But if euro goes to 125, I think ECB will start having problems because a stronger currency is negative for inflation. So we could see some dovish overtones coming from ECB. So in our view, where we are really playing the weaker dollar story is one versus commodities. So we have long gold as a core position in the portfolio. Second, we are very bullish on Asian currencies because when I think about, again, trade negotiations from China or Korea or Taiwan, letting the currency appreciate is an easier way to reset trade relations with the US. So we are very positive on Asian currencies. We are also positive on commodity currencies because we do believe that commodities are going to go up, whether it be gold or copper or iron ore, and commodity currencies should benefit. So in my view, absolutely weaker dollar, but I don't think it's versus euro or versus GBP.
So in terms of gold, you know, Turkey is a gold country. We love gold very much culturally.
I'm Indian.
Yeah, India is also the same. So what do you expect in terms of gold? What are the highest levels that we can see this year?
Our price target is close to 6,000. The reason I am positive on gold, for me, is the best way to express the weaker dollar view. And I do think dollar, like you said, is losing its shine. I think it should weaken going forward. It's also a great hedge against something going wrong. Geopolitical risk or a general risk-off theme in the market, and gold will be a big beneficiary. The third point I would say is that what we have seen is a number of central banks adding to gold portfolio. And that's, again, the weaker dollar view is being expressed through gold. A lot of these central banks are what we call price insensitive because for them, it's a decision on where their reserve should be. It's not based on whether the gold is at 5,000 or 4,500 or 5,000. And that's why I think the structural demand for gold continues to exist over the next 12 to 24 months. So that's why we are positive on gold.
Yeah. So in terms of emerging markets, you have also mentioned that as far as what you say, I understand that emerging markets are like the stars of markets right now. So do you think this can continue? And how do you see the position of countries like Turkey? Because Turkey is a bridge country, geopolitically important country, and everybody's talking about that nowadays. So how do you think this will impact the foreign investments approach towards Turkey in the coming weeks or months?
So if you see the flow of funds, so you look at the mutual fund data, you look at EPFR data, what we have seen is that emerging market dedicated funds have seen quite a significant increase in inflow over the last 3 months. For us, this trend is going to continue. It's going to continue at least for the next 12 months, if not longer, which means that emerging markets in general should benefit. And of course, countries like Turkey should benefit because, like you said, it's geopolitically important. And it's a bridge between Europe and Asia. So for us, we are very positive on emerging markets. We are positive on Eastern Europe. We are positive on Turkey. We are positive on China, India. Of course, I'm Indian, so there is a bias. But we do believe that emerging markets, we have seen in the last 2 months, they have massively outperformed the US. We think this trend is going to continue for the whole of 26.
So lastly, what might be the black swan of this year?
A number of black swans. And like you were talking about, event risk on the horizon. If I look at AI, I think the street does not really know how soon AI is going to change the workplace. And we are seeing new updates coming almost every week, and it's going to impact an industry. So that's one. The second is the exposure that a number of institutions have to AI related. So for example, private credit or private equity. There is a huge amount of exposure to software. There could be exposure to other areas. That is still not yet fully modeled and understood. So that could be another area. So we are very carefully watching the implications that these could have on the market.
So Mohit, thank you so much for making this time for coming to our London studio and having this interview with me. Thank you.
Thank you.
Jefferies Avrupa Başekonomisti Mohit Kumar'la buluştuk. Sözü tekrar İstanbul'a bırakalım.